good Saturday morning. It's time to get some wood in the smoker and that brisket seasoned and ready to go. Pour yourself a cup of your favorite morning beverage and sit around the table with Clark Harvey, the BBQ mortgage guy, your mortgage and financial services expert. Here he is, Mr. Clark Harvey.
Hi, this is Clark F. Harvey, the BBQ mortgage guy. How are you guys doing today? Hey, listen, I got an email today from a client, and I thought this would be a great podcast for you listeners out there. So this is a very common question that I get a lot. I've been doing this over 22 years now. And people ask all the time, what's the difference between a mortgage interest rate that they see on the billboards versus an APR, or what we call an annual percentage rate? That's a great question. So basically, you know, how I've found the easiest way to answer this question is to say, for example, you know, and that's those questions this morning on a 30-year fixed. I quoted a gentleman 3.5 fixed rate, and the APR was 3.529, so slightly higher. And so if you're looking at an APR to compare costs, and that's what it's used for, the tool, is if lender A, me, quoted on a 30-year fixed, same loan amount, interest rate 3.5, and lender B quotes same loan amount and a rate of 3.5, but their APR is 3.7 and mine's 3.529, all that means is the cost to get lender B's loan is more expensive. There's more costs in there. And that's a simple, easy way to answer those. Is just ours is less expensive to get than that. And there's a lot of factors that affect the APR, some of which are the interest rate, the points cost to get that, any of the fees, maybe mortgage insurance is on there. That's going to affect the APR. All those things, an upfront fee, all those things are going to affect the APR. But the simple way is just to know an APR is just a measuring tool to see what the cost is to get that loan. That's it. Super simple. So just be careful. So there's a difference when it's a adjustable rate mortgage. The APR is going to be different than a fixed. So you have to compare apples to apples. And so that's what really the difference is. Just make sure that you do your due diligence. Now, here's one thing that the consumer sees and say, okay, I want to go with, lender A because his cost is lower. Great. Well, what if lender B maybe can get it done quicker and is a little more skilled and so forth? So it's not always about just the cost. You want to hire that person because of what they know and their knowledge and how to navigate and the experience you have. So it's not always about what's the bottom line, the cost, although those are great things. For example, let me help you relate this to something. If you go in, you have some heart problems, go into the doctor, says, you know what, we need to do heart surgery. Okay, great. What's the cost, doc? You don't usually say that. You usually say, well, I'd like to get a second opinion, and why, and find out the reasons why. Why do you want to use this other doctor? Because their method is better or whatever. So it's not always about the cost. Although I will say it's typically the largest financial transaction that people make in their lifetime. And you want to trust that person, know that they have the skills to navigate and understanding the guidelines to help you navigate through that process. And to have a great experience in that process, to communicate well with you, and to communicate in the way you can understand. And that's what I've learned in these 22 years doing the business, how to really, simplify that, communication and that understanding. If you don't understand, I always tell people, let me know if there's a question. It's not a dumb question. I want you to understand what you're doing in the process and what that cost is and why that's there, all those things. And so that's one of the things that separates me from maybe the others. I'm speaking just in my perspective and the things that I've heard over the years from what people have said, and they have a great experience. And then when you're done, you close the deal with me, we're going to smoke some delicious brisket and or some baby back ribs for you, whichever you prefer. I just want to address this question I was asked recently, whether or not APR can be different from the time I see the final numbers come in, and could it change suddenly when I'm at the closing table? That's a great question. Well, in my case, it's been different in a positive way. So lower. So I'm going to overestimate that loan estimate. They used to call that the good faith estimate. It's now called the loan estimate. So I'm going to overestimate those costs. That's how I do it, because there's certain things that, costs that we can't control. In fact, there's only typically maybe 1-2 costs on there that are the mortgage persons or the mortgage broker, maybe an origination and a processing fee. All the other costs are third-party costs. We have no control over those. Title company, an appraisal, discount points, depending on the rate you select, at the time you select it, and your credit score, all those factors go into that. So, yeah, that's a great question. Those things are all costs and can be, I guess, not necessarily hidden in there, but to answer your questions, I like happy people at the closing table. I like it when they smile and say, hey, the line I like to use is surprises are great on Christmas and your birthday, but not at the closing table. Unless it's in your favor, unless it's a smiley face. Like when you go to get your taxes done, you're getting money back, that's a smiley face. We like smiley faces. That's what we like. And it's a simple business. We like them happy, our clients happy, because guess what? They come back and they send their family and friends. Pretty simple business. That's what we love. And so, answer your questions. It does happen. I hear those stories. I hear those things that people cost. They've grossly charged in fees, and now the government's put in places some things that they can't do that anymore. Some tolerances that we know up front before it even gets to the closing table, and so those are some of the things that help the consumer, protect the consumer as well. As far as other things I can recommend on APR is make sure you compare apples to apples. So if someone's quoting a fixed rate, make sure it's the same rate. Make sure, honestly, it's the same day, preferably the same time of day, because the rates can fluctuate at any moment. We can have a price increase. We can have a price change for the better, so the rates got a little bit better. And that's how it works. So fixed rate versus an annual or adjustable rate mortgage is going to be different. And so even though the rate may be the same on the two of those, which generally it's not going to be, an adjustable rate, it's going to be a little bit lower. But that's what you want to look at. All right, let's touch on this topic. I get this a lot, like why are the rates so volatile? That's a great question. Well, it's a supply and demand. It's a market. It's driven by the market, and there's so many factors that it's a world economy now. So what happens in Japan or Greece or South America can and does affect our stock market. And so, and according to that, is the interest rates as well. They're going to be affected as well. So the stronger the economy, the higher the rates to go, because that means it's robust. They can charge more. If the economy's soft, then the rates are going to soften up. And there is a difference between what the rate is and what the cost of that rate is. I tell people all the time, it's like if a client calls in, what are your rates? I say, that's a great question. There's a lot of factors that factor into what the interest rate is for a client. Like, for example, the loan type, a conventional versus an FHA or VA or USDA or a home equity line of credit or a construction loan, or all those rates are going to be different. And also it's going to cause a difference is the credit score, your credit score. That's going to be affected. The loan size is going to affect the interest rate. If you get into some of the jumbo rates, they're going to cost a little bit more. If it's going to be an adjustable rate mortgage versus a fixed rate mortgage, there's going to be a difference there. If it's the loan to value, so the loan size versus the value of the house, how much you're putting down or how much equity you have in the house on refinance. And are you going to take cash out or not? Or is it just going to be what we call a rate and term, like you're not getting cash out? All those things affect the interest rate. So another thing that affects the interest rate is are you going to own or occupy the property? Is it going to be your primary residence? Or is it going to be a second home? Is it going to be investment property? And what property type is it? Is it a single family home? Is it a duplex? Is it a triplex, fourplex? Is it a condo? All those things affect the interest rate, plain and simple. And so basically Fannie Mae and FHA, VA, what I do is someone tells me their situation, I plug it in and say, okay, what rate do you want? Do you want 4% versus 3.5%? Well, 3.5% might be a cost. 4% might be a no-cost deal. We can cover all your closing costs through that. And so that's something you need to think about, and it depends on how long you're going to be in that property. Sometimes people say, I'm going to be there for 30 years and I'm not doing anything. Well, statistically, we know that that's not true. Statistically, it's about 5 to 7 years that someone's either going to move or refinance that mortgage. And so maybe you're only there on a work assignment for a 5-year term. So it's not a bad idea to take a look at a 5-year adjustable rate mortgage. So it's fixed for 5 years and it'll adjust after that. So if you know you're going to be there 5 years, get the lowest rate possible, save yourself some money, and then you sell the place and move on rather than paying just because I want a 30-year fixed. And some people say, well, I just want to pay it off in the shortest amount of time. Okay, 15-year fix. Let's do a 10-year fix. Let's do a 20. We can do 23-year fix, whatever you want. So the terms we can do whatever, and all those affect the interest rate too. The shorter the term, because that means the risk is lowered to the investor. The investor meaning the bank or whoever is going to take the risk on that deal. Now, mortgage insurance affects the APR as well, and it can affect the interest rate. So based on your credit score, that's why it's so important to keep, paying the bills on time and all this. And we'll talk about on another show about credit scores and all that stuff. And because that will definitely help you as you focus on the history of it and all that good stuff. So let's talk about, oftentimes a consumer has been barraged by interest rates. And we've done that largely to ourselves in this industry because that's what we've kind of educated the consumer, like we're about an interest rate. That's all we are. Well, there's a lot more to loan than that. It's kind of like an iceberg where you only see the tip of it, and there's a lot more happening down below. And so when it comes time to find out, inquire about a mortgage, talk to a professional. We can definitely guide you through that whole process and make sure that you get someone else's opinion than just one or maybe two, maybe three. That's fine. Just know, like as a mortgage broker, we talked about last time, that we do the shopping for you. You're going to tell me your story, your situation. We're going to find that best loan product for you and give you the options there, let you make the decision, and then let's move forward and get it closed and take care of you. So what you see on the billboard or online is always going to be different, and it's going to change all the time. So best is to pick up the phone and have a conversation, and we'll have a professional conversation with you and educate you about that process and interest rates and APRs, all those things. Thank you so much for listening. You guys have an amazing, amazing day, and we'll talk to you next time about credit scores.
You've been listening to Clark Harvey, the BBQ Mortgage Guy. Clark is a licensed mortgage loan originator, NMLS number 240452, and his company, First Rate Mortgage, NMLS number 1172332. You can get a hold of Clark at area code 801-562-9100 or at his website at www.thebbqmortgageguy.com.